All right, 2025 mortgage rate forecast, 2025 real estate forecast. Buckle up, strap in. In today's video, I've got slides, I've got data, I've got insight from talking to a bunch of industry insiders. Specifically today, I've got slides from my friends over at MBS Highway. Shout out to Barry Habib, Dan Habib, everybody over at MBS Highway. They did a great presentation that I listened to. I'm going to borrow their slides with their permission. I'm going to give you my take as a mortgage broker, helping thousands of people across my career and still actively operating across 48 states. And so I'm going to add a little bit of my personal takes to the great job that Barry and his team over at MBS Highway did. I'm going to get through it faster than he did, so I might skip a couple slides, but hopefully this is useful for you if you're a buyer in 2025, if you're a seller in 2025, if you're an investor in 2025. There's a lot of good takes here, and quick shout to Barry and his team. They nailed it with home price appreciation in 2024. This guy wins, crystal ball awards for how accurate his predictions are. So when his team does the analysis and the research and puts together predictions, people should listen. They've been accurate for decades. All right, let's jump right into it. 2025 forecast. First and foremost, we're going to talk about the Fed. Anybody who follows mortgage rates, like I do, knows that the Fed, while they don't directly control mortgage interest rates, their policies and what they do with the Fed funds rate definitely, over time has correlation with where mortgage interest rates go. So let's talk about my buddy JPOW and the Fed. Here's the dot plot for 2025 without getting into too much detail. You've got 19 Fed members. They're all going to give their take and plot how many Fed rate cuts there's going to be in 2025. And so as you see here, there's a consensus that's around 3.875, where by December 18th of 2025, that's where they think the Fed funds rate is going to be. There's a couple that expect less rate cuts, and then there's also those that expect more. But the consensus, the Fed median forecast, is right there at 3.875. This will come up later. This is only 2 cuts. This is only 50 basis points. We'll talk about that later and how that's going to affect mortgage interest rates. Unemployment is definitely going to have an effect on mortgage rates. I won't go too far into this, but the Fed is forecasting unemployment from 4.2 to 4.5, so slightly up from where it is today at 4.2% in 2025. 4.4 would surprise 14 of the members, and 4.6 would surprise all 19 members. And so, that piece of data is important because I think there's plenty of signs and signals that unemployment might go higher than some people expect. If it surprises Fed members, their reaction has downward pressure on mortgage interest rates. So watch for unemployment in 2025. Another thing we're looking out for when we want to see what affects mortgage rates is inflation. We know that rates have been higher for longer. In a big way, inflation staying higher for longer is what kept mortgage interest rates higher. The Fed couldn't cut. Their forward guidance and what they were talking about doing in the future all changed because inflation was stickier than expected. It stayed higher for longer than most people expected. So what we want to think about, and Barry's team did a phenomenal job here, is that even though we've got these numbers, 2.8% year over year inflation, core PCE, for the layman, inflation, right? It could be overstated, right? And it could be significantly overstated because there's plenty of data where today's numbers don't reflect what's going on today. And I'll show you how that works with shelter inflation. Specifically, shelter inflation makes up 18% of core PCE. So that's 1/5 of our inflation measure is measuring shelter. Shelter is rent prices and home mortgage prices, right? And so if that is 4.8% year over year, according to their data, and we know that, the CoreLogic's rent index says rents are up 1.7% year over year. Real data, right? Not this shelter laggy data. That's 3.1% of an overstatement, right? It's overstating this inflation number that shouldn't be as high as it is. So if we look at the portion, 18% of core that's being overstated by 3.1% with just shelter, if we strip that out, that's a 0.5% impact on our core PCE number. So imagine if that core PCE number came out at 2.3%, almost at the Fed's target of 2.3%, they'd be much more likely to cut the Fed funds rate. That would have a downward pressure on mortgage interest rates if that number was more accurate, right? Without that shelter lag. And here's monthly shelter readings in inflation. You can see them, how much they've come down from 0.7 back in February of 2023, all the way down to almost 0.2% November of 2024. And anybody who's in the market or following rents knows that rents have really flattened out, right? They might even be decreasing in some areas. So eventually these numbers are going to catch up, and that big chunk, 1/5 of inflation number being shelter, when those numbers get, corrected, or that lag catches up, downward pressure on mortgage interest rates. And so here's something to think about when you think about future numbers for inflation. You replace the number from a year prior. So if the inflation number or the shelter component of that is a really high number, it's a lot easier to show a decrease. And I'll show you the exact number so you can see, like 0.514 in January and 0.443 in February. These numbers are inflated numbers, no doubt going to be lower in 2025. And that's going to finally catch up. And we're going to see, at least that shelter component of inflation come down, right? As inflation comes down, you've got a lot higher probability that mortgage interest rates come down. Annual inflation versus cumulative, we don't need to really talk about that. It's just inflation, the wild ride it's taken recently. It always levels out. It always evens out, and it will, right? It's already calmed down quite a bit, but the Fed, is pumping the brakes on rate cuts until they see that they've, met or well on their way to meeting their expectation of 2%. All right, let's talk about the labor forecast. Unemployment in 2025, and like I said earlier, higher unemployment is going to put downward pressure on mortgage rates. This number is probably higher than current estimates. And let's just look at some of the data out there. Like, unemployment rate is rising, like, no doubt. This is January of 23 through November of 24. So over the last couple of years, and the unemployment rate, steadily increasing, 4.2% today. And, the Fed's prediction, 4.2 to 4.5 for 2025, would be in line with kind of where things look to be headed, or worse, like I said. And if it's worse, that's downward pressure on mortgage interest rates. Over the last 7 months alone, this is a chart that shows the median duration of unemployment, right? Like, when someone's unemployed, how quick do they get back to work? 7.5 weeks, 8 weeks, 8.5 weeks. It stayed in that range for most of 22, and then it started to, slowly creep up in different times of the year, around, some of these seasonal periods, December and November, December, January. Over the last 7 months, there's been a 21% increase. This is something that, if you were worried about unemployment, would be a little bit concerning to see that, spike up in duration of unemployment. And this is a crazy stat. Closings, store like retail closings up 70% in 2024 versus 2023. When you think about this, 850 Party City stores, 580 Big Lots stores, Family Dollar, CVS, Walgreens. These stores have hundreds, maybe some of them have thousands of employees per store. And we're talking about thousands of stores being closed, right? This is no doubt going to have an effect on unemployment and, the job openings. How many jobs are available? Declining. No wonder people are having a harder time, and it's a longer, span staying unemployed. So a lot of data showing the unemployment numbers getting worse. That is all downward pressure on mortgage interest rates. So let's get into a forecast for mortgage rates. I'm going to show you Barry and his team's numbers, and then I'm also going to give you my prediction because they do a great job. I don't always have to agree. I'd probably take their advice over mine, but I'm going to give you mine anyway, or at least my forecast. And we'll see what they've got here. So the 10-year Treasury is projected, or target of 3.6%. And the 10-year Treasury matters because if you've ever heard that there's a correlation between the 10-year Treasury and 30-year fixed rate mortgages, it's as clear as day. You can look at it over the last 50 years. The 10-year Treasury historically is about 1.8% to 2% below where a 30-year fixed rate mortgage is. And so today you've got the 10-year Treasury at, call it 4.6%. And if the 10-year Treasury is at 4.6 and mortgage interest rates are 2.5% higher than that, that's another caveat there, is that historically 1.8 to 2% higher. Currently, because of more volatility, that number is about 2.5%. I'll show you that in another chart. So you take the 4.6, you add 2.5%. That's the spread between the 10-year and the 30-year fixed rate mortgage. And today you've got 7.1% interest rates. I think I've got the chart here, right? Like currently 2.5%. So here's the historic 1.6 to 2% between the 10-year Treasury and the 30-year fixed rate mortgage. For those who haven't looked at this, like it's you could go back 50 years. Trust me when I tell you, you take the 10-year Treasury, add 2% to it. That's about what your 30-year fixed rate mortgage is going to be. And that'll hold true over decades and decades. In October of 2023, this spread was huge, 3.1%, because volatility was high. Things were changing a lot. Rates were going wild, right? That's calmed down. It's not back to historic levels, but it's calmed down to 2.5%. So if you talk to anybody who follows this, they'll tell you we may not get all the way back to 1.6, 1.8, 2% spread between the 10-year Treasury and 30-year fixed rate mortgages. But what if we got to 2.25? What if we got to 2%? It's already down to 2.5. As volatility slows down, as things become more clear, inflation is under control. They know exactly what's happening in the economy and with unemployment, and the Fed's got the ability to kind of look forward with less uncertainty. This number will come down. And so if you want to predict or project mortgage interest rates, you just say, well, the forecast is that with the Fed funds rate coming down and the other data we've got, 3.6% is our target for the 10-year Treasury. Then you just add the 2% to the 2.25 spread between that 10-year Treasury and 30-year fixed rate mortgages. And this is where I'm going to go out and say, 6 months might be a little bit aggressive on the timeline. And so I might not be as bullish or whatever you want to call it on mortgage rates coming down as Barry and his team at MBS Highway, but they're showing you that this is possible. You take that 3.6, and like I said, the spread comes down to 2.25. He's not even saying it's going to come down to 2%. And 2% was kind of the top end of historical between 1.6 and 2%. It just comes down to 2.25. You add those two together, and you've got a 30-year fixed rate mortgage at 5.85%. Again, I'm going to go out on a limb and say, I don't know if it happens that fast. It might be 12 or 18 months out. Heck, it might be 24. Some of the stuff's going to depend on if all holds true with those inflation numbers, and those inflation numbers coming down relatively quickly with a couple readings in January and February, which will come out in February and March 2025, showing that inflation has calmed down, showing that shelter component of inflation has come down. And so maybe the 10-year treasury only goes to 4%. Maybe, 4% and 2.25. We're at 6.25. Either way, there's a lot of signs that point towards mortgage interest rates coming down in the future. The real question is how much and how soon. These last couple of years, we've got quite a few okie dokes, but if Barry and his team are correct or even close, this bodes well for home buyers, and this bodes well for a lot more transactions happening. We know when mortgage rates get below 6%, there's a lot of activity in the housing market. All right. Speaking of the housing market, let's jump into the real estate forecast. A lot of people poo-pooing real estate, saying that it can't continue to climb like it has over these last few years, 50, 60, 70% home price appreciation over the last 5 years, depending on what market you're in. The funny part is even some of these housing bubble guys, I've seen some like realistic stuff come out of their mouths and on their videos lately where all of a sudden they're like, well, the housing market's probably going to be flat. Like, oh my gosh, you went from it's going to crash 40% to it's flat. And so again, Barry, MBS team, the guy's a crystal ball winner for hitting it. He predicted 4.5% home price appreciation in 24. Everyone said he's out of his mind. Real estate was going to crash. He hit it right on the friggin' nose. So congrats, Barry. You're the man. We'll see how this year's prediction does. Quick look at the U.S. housing market. This is interesting to look at as a mortgage broker because we've got 136 million households. 45 million of those are rented household. 91 million are owned. And oh, by the way, if you're a fan of real estate, this is a fun stat to look at. The total equity in those rentals is zero because you don't gain any equity renting. But there's 37 trillion in equity from those homeowners that own those 91 million homes. About 400,000 is the average per household. Crazy stat about mortgages is of these 91 million homes, 35 million of them are free and clear, no mortgage. That's a crazy, crazy stat. And then 56 million of them have mortgages. What is that? 56 out of 91, like a third, more than a third are like almost 40% are free and clear. That is wild. And then of course, everybody who's like, oh, you're going to be upside down because the housing market, 1 million, 1% are upside down. And, they're 300 million in negative equity against the 37 trillion in positive equity. Really, really, not a concern. So demographics is destiny. If you're like me, I've followed Barry for 10 years. This stuff is gold because you can look at the housing market. You can look at demographics, which tell you, baby boomers have this many, in population. And then you can look at like the average age of a first-time home buyer, and you can project like when are Gen Z going to buy homes? When are millennials going to buy homes? And without getting into too much detail, we just know over these next few years, with 73 million millennials, and 33% home ownership rate when they were 30, or a 55% home ownership rate when they were 40, we can like forward project how many household formations, kind of, way of saying like when they're going to buy, are going to happen over the next few years, right? So home ownership rate currently for millennials is 45%. Their median age is 35, right? By the time they're 40, that home ownership rate is going to be 55. So like more of them are going to buy. But just extrapolating these numbers, right? Over the next 10 years, going from 33% to 55%, because more millennials are going to be of home buying age, household formation age, getting married, having families, buying homes. That's adding 8.5 million more homeowners. And then Gen Z, their median age is 20, but there's near 70 million of them. This is forward looking a few decades, right? Just like what's going to happen with demand, right? Because 8.5 million here, 17 million here. We got to be fair, though. We got to be fair. Some boomers are going to pass. Some boomers are going to sell and move into assisted living or whatever they do. So like we could just lop 5 million plus off of this number. We still got 20 million households being formed. Wait until you see the discrepancy between household formations and what's being built. And then you'll understand, like, why is there still a lack of supply? Why is, homes still feel so scarce? You'll see the numbers don't lie, right? Active listings, have started to creep up, but man, they were at like historic lows. 20 and 21, as you can imagine, people were just buying stuff like crazy. I saw an interesting stat lately that 1995, we had more inventory than we do currently, but now we have 60 million more people, right? We went from 280 million people to 340 million, and active homes for sale is the same number. That's speaking to, just the scarcity of homes. And, when something's scarce, the last thing you should be thinking about is, that thing's going to become cheaper in the future, right? Name one thing that's scarce, limited supply that people want, that's gone down in price. That's not how supply and demand works. Year over year, active listings have gone up 27%. That's good news. Getting some inventory back, and depending on where you're at in the country, it's even higher than that as far as inventory goes. But I guess 21% less active listings than 2018, but we've got 12 million more people. Kind of like the stat that I shared, all the way back to 1995. Less listings, more people. Supply and demand. Simple math, even for a dummy like me. And so, household formations, this number is tracked, and it's about 1.9 million per year. Household formations. Housing starts. This is a wild stat too, because builders, man, like, I get it. They're not all bullish and don't want to just build like crazy, but they should. Over the last 10 years, there's another chart that's not included here. Literally every single year, we've built less homes than we've had household formations. So if you thought housing supply was in bad shape a decade ago, it's only gotten worse. We've only added more people, and the number of homes built, housing starts, has lagged. It's gotten worse. It hasn't gotten better when we talk about supply. And now we've got this working against us into the future. And the reason why we're talking about this, as a reminder, is you can take any asset, real estate included, and I would say especially real estate, and just look at supply versus demand. 20 and 21, Mortgage rates were low, so demand was really, really, really high. And supply wasn't even that short yet. But with so much demand versus the limited supply that we had, drove home prices up. That's what drove home prices up. If you forgot, why did home prices go up by 70% in some markets, 85% in some markets over the last 5 years? Because demand outpaced supply. Like, that's the simplest explanation for it. And look at what's happening into the future. 1.9 million household formations per year and 1.3 million housing starts. More people than homes. Not getting better. All right, let's look at the 2025 real estate forecast based on all of that, right? All of that info that we've seen, supply versus demand, like that has upward pressure on home prices. And I might let the cat out the bag, but I'm going to end with, Barry and his team's predictions. I'll tell you what I think about it, but data doesn't lie. As much as people want housing prices to come down, they want prices to come down, they want interest rates to come down, and they want wages to go up by 30%. Like, wishing for it, unfortunately, doesn't make it happen. But 2025, 4.1% year over year home price appreciation. If you wanted to put some numbers to that, a $500,000 home on January 1st, 2025, over a year, if you get 4.1% appreciation, it will have increased in value by $20,500. The good news about real estate is you get to leverage it. So you don't have to put $500,000 out of your pocket to see this $20,000 in gain. If you put 3% down on that home, you're putting a $15,000 down payment. And then after just 1 year, if home prices go up by 4%, your home's appreciated by $20,000. That's 133% return. Better than even meme stocks, guys. 5-year cumulative home price appreciation, 30 to 35%, which, I know plenty of people that are like, I'm going to wait. I want to see what happens. Unfortunately, a lot of them did it from 2017 to 2022 or 2019 to 2024. And, I've got thousands upon thousands of records in my Dropbox of people that I talked to. I, showed them a scenario at 300,000 with 5% down. No, I'm going to save a little bit more. No, I think it will get a little bit better, because the same type of talk track that was happening now and happened last year and the year before was happening in 2015 and 16 and 17. Home prices have gone up for 7 years straight. They got to come down. Home prices have gone up for this number of years. They got to come down. And so this is just kind of a reminder, when you get into, purchasing real estate, and this isn't a pitch, guys, just sharing the numbers. Waiting can sometimes be, to be honest, disastrous. And so I guess if you wanted me to put my little tidbit onto here as to why I think about it, I think this is highly dependent on mortgage interest rates, because I think that the demand side of things, even in this environment we're operating in with limited supply, if rates got sub 6%, for sure, there's going to be a lot of upward pressure on demand and upward pressure on prices. If rates stay elevated and, 7% now, if they stayed above 6.5, 6.75%, like it's a stretch. Affordability is a problem. And this could lead to price softening in some markets. There's Florida markets, there's Texas markets. There's plenty of markets I can point to. We're operating in 48 states at UMortgage where, the gains they saw in past years were not only unsustainable, but a little bit, inflated because people were uber enthusiastic. And so some price softening to bring those down 5 or 10%, right? And so what I'm saying is if rates stay high, I expect this to be closer to zero. I expect it to be flat. If rates come down, sub 6.5%, 2 or 3% appreciation. Sub 6%, the number's probably even higher than this, which again is not what people want to hear. People don't want houses to be 6% more expensive in 26 than they were in 25. But it's simple supply and demand. sometimes. So that's it. Let me know what you think. I think that's all when it comes to, oh no, we got more. Home price appreciation, 4% to 4.5%. Oh yeah, this is all of MBA Highway's forecast. So I'm going to leave these here. I'm going to talk them through, and then you leave in the comments what you think about them. It'll be fun to have some discussion. There's always some naysayers. There's always some people who agree. There's always some people that tell me, I'm an idiot, and other people that call me a genius. So I'm here for all of it. Leave your comments below. Again, MBS Highway, Barry Habib, Dan Habib, the whole MBS Highway team. Thank you so much for letting me borrow these 27 slides. Thank you so much for the presentation. Great information as always. We'll leave it here with these predictions. 4 to 4.5% home price appreciation. Core PC inflation, 2.1 to 2.2% from the 2.8% it's currently at. And again, like we talked about in the beginning, if some of those numbers that are lagging when it comes to shelter inflation come true, like this inflation numbers coming down in a hurry. Unemployment rate 4.5 to 4.6 from the 4.2. Remember back, right, where like all 19 Fed members are going to be surprised if unemployment gets to 4.6, and that's what Barry and his team are predicting, which I think is a good forecast given all of the stuff we're seeing, all the store closures and whatnot. The Fed funds rate 3.25% to 3.5%. Again, if you looked back, the Fed funds rate currently 4.3. 10 Fed members think we're going to land at 3.8. This is below where the Fed is predicting it. And I think the inflation numbers and the Fed funds rate are dependent on each other. If those inflation numbers come down as predicted, this Fed funds rate will come down, right? Another 2 to 3 cuts from what's currently being predicted, which is only 2 cuts. So time will tell. This will be interesting to look back on the end of 2025. And mortgage rates, this is the one that the $1 million question, 5.75 to 6% from the current 7% we're at. Now, if that happens, there's going to be a lot of action in the real estate market. Me and my team will be ready to help. Go to greatmortgagebroker.com. If you want to connect me and my team, again, we're licensed in 48 states. We're happy to help. greatmortgagebroker.com. That's where you find me. Thanks for watching. Until next time, we gonna see.